Thank you so much. Thanks, everybody, for attending today, the Traders Roundtable Summit here. Thanks to Jeanette. And today I'm going to be talking about catching big trends with Bollinger Bands. Okay, they're a great tool, a great indicator, and you can virtually use this particular strategy with any market, any time frame, any way you want to actually purchasing the equity in the future or the option on the equity. It's really up to you. I'm going to give you the complete rules. You can start trading this as early as Monday if you'd like. And here's the best thing. It doesn't cost anything. You can, with what I'm going to be sharing with you today, you can use on just about virtually any charting software. Now, I'd like to start out by sharing with you an example here. If we look at this chart example in Tesla, at the end of the year, December, we see here just this small amount of price charts here. With what I'm going to be sharing with you today, you could have been able to enter long into Tesla well before just by looking at these three bars right here. And this would have been your setup to go long, and then hopefully you would have been able to ride most of this nice move to the upside. And then conversely, this same technique I'm going to be sharing with you, all of the rules, all the complete strategy rules. If we look at this chart of CBS here, you would have been able to do the exact same thing to the short side if you like, just by looking at this one little pattern right here. Hopefully you would have been able to catch on that on the short side and take advantage of this down move. So this promises to be a great presentation. Once again, welcome. My name is Primo. I'm the president and founder of Specialist Trading. And if you're new to my presentations, we are all about educating our students and our members around the world. We are first and foremost an educational company. That's our sole goal. Even though we have lots of strategies, lots of different trading techniques and methods that I've accumulated in my trading career, it's more about teaching you all of these things so that you can put the power back in your hands. It's been my experience that the reason why most traders fail is because you rely on someone or something else to tell you how to trade. And then you make your trading a little bit too more complicated than it has to be. I'm going to show you how simple it can really be to get on that road to consistency. So we are just all about educating you. We have our methods traded in virtually 110 countries around the world, in every state in the United States. I've been trading for 40 years. I started my career on the floor of the Pacific Stock Exchange. I was on the floor for a total of 16 years, and 9 of those years I was a specialist. That's where we get the name specialist trading. A specialist, if you're not familiar with what they did, doesn't mean you're any more special than anyone else. It just means that if you wanted to purchase, buy, or sell a particular equity, you had to go to the trader who specialized or who made markets in those stocks. So I made markets in roughly about 50 stocks. I did that for 9 years. I traded through the crash of 1987. I traded in the bull market that followed, and I left the floor in the mid-90s to manage money and to pursue my own trading. And just about 9 years ago, I started Specialist Trading, where all I do is teach and mentor students around the world the things that I've accumulated, and that I use in my own personal trading. So hopefully we'll get you on the road to consistency with the things that I have found that have a high level of consistency. Now, as I said, I'm going to teach you a great strategy you can start using as early as Monday if you like today. All the rules, entry, stop placement, exit, but we're required to show you this first, so please take a moment to view our disclaimer. I'm going to show you a lot of performance results using this particular technique, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. So once again, we're required to show you that. And as you're taking a brief moment to view our disclaimer, I would also like to tell you that when I first started trading roughly 40 years ago, I struggled just probably the way many of you are struggling right now or have struggled in the past. So I know what it's like to be that discouraged and to really go through a lot of things, to read all the books, go to all the seminars, go to all the webinars, and think you're doing everything right. And maybe you have 1 or 2 good trades, but then ultimately you give it all back in the next trade, okay? Well, we're here basically not to give you this $1 million system or to give you this trading strategy that we promise will make you rich. We don't believe in that. We're just providing you with education. So as you see here, my goal is not to force feed you signals. My goal is not to force feed you the perfect time frame or market to trade. My goal is simply to teach you how to trade. This was the same concept that turned my trading around. I feel has been able to sustain me for 40 years, and this is what I do with all of my students and members. Okay, so we're an educational company. I'm going to educate you today. So here's what you are going to be learning today, since this will be a class. I'm going to start out by sharing with you the common uses for Bollinger Bands. A great tool, a great indicator, once again, put together by John Bollinger. But we're going to show you how most people commonly use it. And then we're going to talk about some proprietary settings that we have specifically for this strategy I'm going to be sharing with you. And then we'll talk about putting these together, which formulate the strategy which we're going to be learning today, and that's strategy 3A. Okay, it is basically a breakout or a continuation strategy because we're trying to capture a really big trend and we're waiting for some type of a breakout, but we need a couple of indicators or something just to tell us when that's going to be taking place. Okay? All right, so let's start out. Let's review for all the people who aren't familiar or who don't use Bollinger Bands. Let's just give a refresher course on exactly what they are. Here's the standard definition. Bollinger Bands consist of a center line. This is the moving average, and two price channels. Those are the trading bands, and they are above and below it. Now, when the markets become more volatile, when there's a lot more movement, the bands widen or they move further away from the average. That's the median channel. And during less volatile periods, like in the summer when there's hardly any movement, the bands contract or they move closer to the middle average. Now, the tightening of these bands is often used by technical traders as an early indication that the volatility is about to increase sharply. So it's giving us some type of an edge or an early warning that a movement, volatility is going to come back into the market, whatever we're following, whatever time frame, once these contract, when the high band and the lower band are contracting towards the center. So if we look at these standard charts, these older charts here, we see that these are the Bollinger Bands, the standard settings, and where the top one is coming lower and the bottom one is coming higher, they're contracting, and then you get some nice volatility moves to the upside. Conversely, we see here the top one is going lower and the bottom one starts to head up. You have a nice contraction. And in this case, the volatility decided to go lower. Okay? Now, this is all well and good. This is fine. But, at specialist trading, we want things a little bit more cut and dry. For example, which direction is it going to go? How am I going to find out which direction? And oftentimes it's too late. Or, how do I know how much they're going to contract? Maybe it's just a false signal. So this is where we come into play with strategy 3A. We're going to use the Bollinger Bands, but we're going to edit them to help us be a little bit more decisive and a little bit more cut and dry on how to enter into this particular strategy. So these are the highlights behind this particular strategy. It's a continuation technique. All right, we're not looking to pick bottoms or tops. It's not a pullback strategy. We're looking for a sort of a small little trend to start. We're waiting for a pause and then the continuation, and that's when we get on board. Okay, it uses a unique Bollinger Band setting. Now, this is designed to trade quick, powerful trends, but remember, it can be applied to any market, any time frame, and any direction. So it doesn't matter if you trade stocks. I'm going to show you a lot of examples with stocks. It doesn't matter if you trade intraday futures. It doesn't matter if you trade currency pairs. It doesn't even matter if you don't even purchase those, but you purchase options. You can still apply whatever tradable unit you like to these setups. Now, with all of our techniques that we teach around the world, we always tell our students to please learn the strategy first. This means paper trading in the beginning. There's so much to learn from this practice. If you think of any vocation, any person who does anything in life other than trading, there's always a practice period. There's always a period where they go through the motions, a rehearsal, okay? Actors, actresses, musicians, they always rehearse. Athletes go through practice games or they have practices. Trading is no different. You shouldn't just say, okay, I understand it, now I'm going to invest all my money. Because inevitably, you'll most likely lose money because you're implementing the strategy wrong. So please paper trade this first so that you fully understand the process, and then when you really think you've got it down, then we would say start out small, okay? Our edge here is consistency. I'm not going to promise you that every trade is a winner. Every trade will produce thousands and thousands of percent. We don't believe in that. If anyone tells you that, in my 40 years I've heard people say that, I would run because it's just not the way trading is. Trading is about being consistent. It's not about hitting home runs. But trust me, when I was on the floor with roughly about 400 or 500 people trading there. I knew a lot of traders who made tons of money in a relatively short amount of time, hundreds of thousands, if not millions of dollars. And guess what? Not one of those traders is still trading. Why? Because they gave it all back. So it's not about hitting home runs because you can easily just give it all back. Successful trading is about consistency. 2 steps forward, 1 step back. The 1 step back meaning that you know from time to time you will have some small losses, but because you trust in your method, in your strategy, you know it has this consistency to hopefully make it back many times within the next trade. So that's the only thing we teach and trade at Specialist Trading are consistent methods that are 2 steps forward, 1 step back in their approach. Okay, so let's talk about the standard Bollinger Band settings. These are what you're going to be applying today, but we're not going to use them in the standard format because the Bollinger Bands are usually set to a moving average. Remember, that's the middle moving average, which is set at 20. All right. Now, the upper band deviation and the lower band deviation, don't ask me to go into the technical description of this. It just means basically the distance they are above the middle moving average and below the middle moving average. The standard default is set at +2 and -2 because they're going to be equidistant from the median Bollinger Band. We are going to alter that a bit, but if you want to see what standard settings look like on this older chart of Facebook, this is the way they appear, okay? They kind of have this very wide, and as you can see, there's the contraction going on here, okay, and some type of contraction here. But they're very wide, and here is your middle Bollinger Band, and that is actually the 20-period simple moving average. Here is how we're going to change them. We're going to keep the moving average, the middle line, at 20, but we're going to change the deviation. We're going down, okay? So in other words, rather than have them set at +2 and -2, we're going to go down to fractions. We're going to have the upper band deviation set at +0.382, and the lower band be the opposite, just to the downside, at -0.382, okay? So it's a fraction. It's not going to be a full whole number. +0.382 and -0.382. So usually with any charting software you have, you should be able to change the deviation. If you're having trouble with it, just contact your tech support for whatever charting platform you have. They should be able to tell you how to change it, okay? But these are the settings we're going to be doing. We're leaving the moving average alone and simply changing the upper band deviation and the lower band deviation to +0.382 and -0.382. We're going to fractions, okay? So if we look at the standard setting of Bollinger Bands, here's the way they usually look. But now that we apply our edited settings, this is the way we're going to be looking. You see how it's more like a nice smooth river. We have this nice flow here as how the Bollinger Bands are set now. We don't have that contraction so much because we're not going to be using that. That's not going to be helping us in this particular instance. We're looking to apply this as our entry point and define when a breakout will happen. Okay? All right, so let's give you the rules. Once again, these are going to be the rules step by step. I'm going to show you a lot of slides. The first examples are going to be on some older charts just for educational purposes so that you fully understand the concept. Because remember, once again, I want you to understand this. I know this is all being recorded, but I want you to understand this so that you don't start trading it and lose money because, once again, it's been my experience that that's why most people lose money right off the bat when they purchase a new strategy or system. They're implementing it incorrectly. So my job here is to teach you how to implement it correctly. So we're going to go through the rules step by step. We're going to start out with the buy rules, and obviously the sells will be the same rules. We'll just turn them upside down. All right, step 1. We want to see 5 consecutive price bars close either on or above that highest Bollinger Band. So if we look at this chart here, a 5-minute chart in the E-mini, now, once again, it doesn't matter if we were looking at a monthly chart of IBM or a weekly chart of the Australian dollar. It makes no difference. It's the same concept, okay? We just happen to be looking at a 5-minute chart here. As we see, we have the proprietary setting of the Bollinger Band applied. We see our chart here with the price bars oscillating above and below. But now what do we have? We have a total of 5 closes. 1, 2, 3, 4, 5. Okay, so that's what we're looking for. 5 closes either on that top Bollinger Band or above. Okay, that's step number 1. Step number 2. Now we're going to look, now that we have the 5 closes above, we're going to look for a short-term pivot high to be created, and it must be above that highest Bollinger Band. Now, a short-term pivot high is simply a high. It's a 3-bar pattern. It's a high followed by a higher high and then followed by a lower high. So if we look at a scenario here that's an ideal reference to this, bar number 1 creates a high, bar number 2 creates a higher high, and bar number 3 creates a lower high. So you have this type of an arrowhead approach here, okay? This is a short-term pivot high. So once we have 5 bars closing above that highest Bollinger Band, we want to look for a short-term pivot high. Now, we can either be within those 5 first bars or it can happen afterwards. It doesn't matter as long as it's above that high Bollinger Band. So if we look now at this chart again, we see that those are the 5 closes above, and what do we have here? Here is the pivot high, okay? A high, followed by a higher high, followed by a lower high. And it wouldn't make any difference if we were looking at candlestick charts. It would make absolutely no difference. You would just look at the wick, the top of the wick, as your high, okay? We're not going off of closes for the pivot. We're just simply looking for the high of the bar. Okay, so we've identified the short-term pivot high, and now we're going to enter to buy when price trades 1 tick, or if you're trading currency pairs, 1 pip above that short-term high, okay? So as we look here, here's the short-term high. Let's follow this bar by bar, okay? This is where we want to go long at this level here. Now the next bar, well, it goes up, and then we continue to go higher and higher until ultimately we intersect it. Now remember, we don't have to close there. We just want to trade 1 tick, and that's our entry, okay? So this is the point in which we would enter and do the trade. Now, one thing I'd like to stress is that while you're waiting for price to go up and trade above, if we start to trade below these Bollinger Bands, anywhere within them, a close, in other words, in their realm or below, then the trade is negated. Why? Because it's the market telling us that it's lost momentum. Remember, we're looking to catch a big trend. And if we're above this Bollinger Band proprietary setting, it's usually telling us, the way this is telling us, that there's a nice trend in place because we're above the highest Bollinger Band. But if we start to close below and then close even lower, that's telling us that the momentum is dissipated. So we're not going to use this setup anymore, and we're going to look for another countdown of 5 new bars to close above. But as you can see, we never went below that top Bollinger Band. So this is a valid entry point right here. Now, where do we exit? All right, well, step 4. We're going to exit on a range extension of 200 and or 300%. Okay, so what does this mean, a range extension? A lot of people aren't familiar with this. Well, it's very simple. Here's where we entered, okay, into the trade. And once again, it would not matter if we're looking at stocks or currency pairs. It's the same concept, and I'll show you a lot of charts in the coming moments just ahead. But remember when we found that short-term pivot high right there, okay? That is the top of the range right here. And where did this rally start to create that short-term pivot high? It started back here, okay? So this is our range from here to here. We're going to measure that however many amount of points that is. This is 100% range extension. All right, so what do we do with that amount of points, okay? Well, we simply double it. So whatever the top of this is, where the top of this short-term high was, we simply add that same amount of points, and that gives us 200. And we can take our profits there, okay? And if we want to get more gains, we can add another 100% range extension to give us 300%. And this is where we would exit. And hopefully we would stay on for this trade for a 300% exit, or 17 points in just roughly about 3 or 4 hours, okay? That's about $850 per contract. Now, a lot of people say, well, Steve, where do you protect yourself? Where do you place your stop? Usually the standard stop is that once you enter here, okay, we measure the range from top to bottom, that's 100%, usually around the 50% level, okay? So if you would exit at 200, it's basically about 2-to-1 risk-reward ratio, and then you can have a much better risk-reward ratio up here. Another way people like to trade this is they'll say, okay, I'll have my stop at the 50% range extension down here, okay? And if we get to 200, I'll move my stop to unchanged. And if we get to 300, I'll exit everything. Still, other people say, well, you know, I'll keep my stop here at 50%. Once we get to 200, I'll sell half my position. Once we get to 300, I'll sell the remaining portion. There's a million ways to trade this. It's up to you. Remember I said at the very beginning of this presentation that our job as an educator is simply to provide you with these techniques that have stood the test of time, help and mentor you decide, but mainly have you decide how you want to trade it, not going into a chat room and listening to somebody tell you what to do that day. We want to put the power in your hands because, as I stated, in 40 years, that is what I have personally found is the only way one becomes consistent in trading, by making your own trading decisions, okay? Okay, so that is the method in a nutshell, all right? That's the standard concept. Let's look at some more Strategy 3A examples in all markets and in all time frames. Let's start out with stocks for all of you stock traders, okay? All right, remember we started out the presentation with looking at Tesla. We said how you could have purchased it down here just based off of a really simple strategy. So looking in hindsight, it's very simple and easy to say, well, sure, Steve, yeah, I mean, it's easy to know I would have wanted to be long here, but how could I have gotten long down there where that green circle is? Well, the first thing you do is apply our proprietary setting to the Bollinger Band. And remember, you can do this on your own. This is nothing you have to buy. There's nothing you have to purchase. It's simply you just have to make the edit on your own charting platform. All right. So now that we've applied it, all right, let's say it's early December, and we're counting the bars above and below. So we have 1, 2, 3 closes above, no, nothing here. 1, 2 closes below, nothing here. But now what do we have? We have sustained closes above. We have a total of 5 closes. So great. That's step 1. Step number 2 is we want to look for that short-term pivot high, that little arrowhead in that 3-bar pattern. It can either be within those 5 bars or it can follow any time after that. Well, as we look here, there is no pivot here except on the very next bar. We do have it, a high, a higher high, a lower high. So this is our setup right here. We're going to go long if we trade 1 tick above. And as you can see, we never traded back down and closed below, telling us that there's still a strong trend here. Had Tesla come back down and closed below here, we would have negated this setup. But it never did. It stayed above, so we would have entered Tesla at 203.01. And I realize this is an expensive stock. Not everyone's going to be purchasing Tesla. You could have purchased long calls or some type of option strategy to the long side. It doesn't matter, or even an odd lot. Either way, this was the buy setup. All right, so now that we're in the trade, we measure the range. Where was the top of that pivot, and where did the rally start? Well, right here, right? See? Here was the top of the pivot. Here was the bottom where the rally started, so that's 100%. So we'll place our stop roughly about halfway down that, and we could have exited at 200 for a quick 23 points in about a couple of weeks. Not bad, huh? Or if we wanted to go for more, we could have gone out at the 300% range extension at 249 we would have exited, okay, for about 46 points. Now, as we were doing this, you could have raised your stop to each different level or used any stop placement you'd like. And the point is, this is the beauty of this technique because it's keeping you in a trend. Now, the only caveat, the only suggestion we make is, especially when you're beginning, we would suggest to all beginning traders of this methodology to exit at the 200 and or 300. Once you get a little bit more experience under you, we would say, okay, it's okay to go up to 400. But that would be it. That would be the most, because it's been my experience that over time, most trends change around the 400% range extension. All right, so you don't want to be having a really nice profit, in this case, roughly 69 points in about a month, and then giving it all back, because oftentimes the trend will stop and change. You see how it did right here, and you'd be giving away some of your profit. So it's good to track the trade, move your stop up to the different range extensions, and in the beginning, exit at 200 or 300, and then once you have a really good feel for that, you can go up to 400, but it would probably be best not to do any more than the 400% range extension. You see how simple this is? No need to look at any news, no need to follow any earnings, there's no need to, subscribe to any signal service. The power is in your hands. You're deciding whether you want to trade this or not. You're deciding where you're going to place your stop, okay? Now, the main thing is we want to put you in the driver's seat. We don't want you to be relying on someone or something else to tell you how to trade. How about CVS, okay? Once again, in hindsight, someone's saying, well, yes, Steve, obviously I wanted to be short this stock or out of it, but how would I have known that? Well, we just add the proprietary setting to the Bollinger Bands, okay? We see here that we were originally oscillating above 1, 2, 3, 4, 5. We had a 5 here, but we didn't have a short-term pivot high, and then we closed below it. So all signals are gone after that. We negate that setup. And now what do we have here? Now we're closing below, and we have consecutive closes below, a total of 5. So we start looking for that short-term pivot low right here, see? We have a low, followed by a lower low, and then a higher low. This creates this type of a V approach. So this is where we're going to be entering. As long as price doesn't go back up above these Bollinger Bands here and stays below them, it's telling us that most likely a strong downtrend is in play. So we're going to enter on the first break of this pivot, which we did at 92.24. The sell-off started right here, and this is where the pivot was, so that's our 100% range. If you would have exited at the 200%, you could have gotten out at 86.06 for a good quick 6 points. All right. If you wanted to go for 300, you would have fared even better because you would have had a limit order here, but on this gap opening down, you could have purchased right here at 69.07 for a really nice 22.5 points to the downside. Okay. And once again, you could have put your initial stop right here. Once you got to 200, you lower your stop down to unchanged. Once you got to 300 or so level, you lower the stop here, but you would have exited. How about SCG, a little cheaper stock, still expensive, but you know, going for that quick trade because, as we stated, especially in the beginning, we'd like you to exit at the 200% range extension. Well, obviously this has been going down, but you could have gotten short well up here. How could we have done that? We add the Bollinger Band. We see that we have closes above, but we never went above the pivot high, and then we close back below, so there's no setup there. Now we have 5 closes below. We got right back up to that lowest Bollinger Band, but we never closed within it, so it's okay. As long as we're still closing below, everything is fine. So here's our short-term pivot low. We entered right below there, 1 tick below on this bar here, right at the end of January, okay, at 70.09. Here's where the sell-off started down here, so there's 100%. We simply subtract that now because we're short, and we exited with a nearly 5-point gain, okay? And once again, if you were protecting yourself, you would simply place your stop halfway up here, roughly at the 50%. And as we see here, we got down to the 200, and the trend changed. So it's always good to protect yourself, at least take some off the table at that 200% range extension, especially in the beginning. Here's an older chart Amgen from last year. All right, once again, we're above. We have some closes above, but we never went above the pivot high, and then we switched gears and started having consecutive closes below, and we're staying below the lowest Bollinger Band. We have a total of 5 closes. Here's our short-term pivot low right here. So we went short at 164.43. Once again, you could have purchased puts. It wouldn't make any difference. And then we simply measure the range extension, where the sell-off started, right from the top there. That's 100%. And you could have placed your stop here or here. It's up to you at that little pivot high there. And here's the 200 and the 300 range extensions, all the different places you could have taken profits. And as you can see here, had you taken this one, the 300, that's nearly 25 points in just about a month's time, coming into November of last year. Now, here's a current chart of the spiders. Once again, someone could say, well, Steve, this is easy. I mean, anyone can tell this thing's been going straight up. You're right. But wouldn't you have liked to known to get long roughly around here? How could we have taken advantage of that? Well, it's simple. You just add the Bollinger Band setting we've talked about, okay? Now, we have settings right here, but we never have enough closes. 1, 2, 3, 4, 5. So we're looking for that short-term low. We never went below, okay? But now we have a total of 5 closes above. And we have a short-term pivot high right there. So here's our entry point right here at 218.32. Now, once again, you could have used this as a market timing tool. It doesn't mean you have to actually buy the spiders, but the spiders are the ETF for the S&P 500 index. This could have been giving you a warning to go along the market that if there's going to be a nice long trend in the spiders, obviously there's going to be a nice long trend in the S&P 500 index, okay? So you could have used this as a market directional tool. Simply measured there to tell you how high this is going to go. And as you can see, you would have been able to exit rather quickly at the 200% range extension, move your stop up. And if you wanted to go for 300, well, you'd still be in this trade, but we're almost there, okay? As you can see, we're just barely pushing the 300% range extension exit at 238.17. Are we going to get there? Well, no one knows, but either way, if I were in this trade, I would move my stop up to here, and in that way, at least I'm protected on this amount of profit, okay? But if we did go up here, well, that would be a profit of nearly 20 points coming from December all the way into the first couple of days of March. Possibly we may hit there on Monday. So this is something to track on your own to see if the S&P or S&P ETF, which is the spiders, gets up to 238.17. You know that you would have hit your 300 range extension. Remember, we're not following any fundamental news. I was a specialist on the floor. I made markets in 50 stocks. If there was anyone who was supposed to be following news, don't you think I should have known that? I was making markets in those stocks. I had to know about the companies, off face value. I had to know what their earnings were going to be, what type of shape they were in. My mentors saw how much I was struggling because I was doing all those things and it wasn't helping me. And they said, Steve, unless you're investing, there's no need to look at news. There's no need to worry about earnings. If you're in and out of a trade in a matter of days or weeks, all you have to do is look at price and listen to what the market's telling you, not what an outside source. There's no reason to overcomplicate your trading by putting these, what they call useless noise, onto your trading plan. So I stopped looking at noise over 35 years ago, meaning news, and I'm still here. So I don't look at the news. If you want to, I'm not telling you how to trade, but there's really no need for it if you're trading or swing trading. The only thing you need to really know is what the price is doing, and then just jump on board. Now, another way you can use this, as we stated, is as a market directional tool. Here's an older chart of the industrials, okay, the Dow Jones Industrial Average. This was last March. We're using the same technique here on daily bars. We're above the highest Bollinger Band. We have 5 closes above, all right? Even though we went intra-bar below, we are still closing above, so that's all we need to see. And here's our pivot high. So obviously you can't buy the Dow Jones Industrial, but here's where it gave you a buy signal to enter. This was last year in March. Now that's your 100% range extension. So you would have known that there's most likely, not guaranteed, but a nice rally is going to take place within the coming months. And that's where most likely it would have first have gone. This was in March last year, and as you can see, in the following 2 months, the Dow went up nearly 1,200 points just based off of this technique. It didn't care about news. It didn't care about the elections. All it looked at was price. Because what my mentors taught me is that the market usually tells you what it wants to do in advance, okay? And the reason why we listen to news or we listen to people in trading rooms or we listen to the guys on TV is because we're trying to substantiate why the market did something. But if we forget trying to look at the market that way and just learn to listen to it, it's a lot easier and also a lot cheaper. You don't have to pay for all these outside sources. Here's an example. Here's an example of how oftentimes the market will tell you what it wants to do in advance of the news. Now, this was just last week. HP's earnings show the PC market is finally starting to recover. Personal computer and printer maker HP Inc. on Thursday saw its shares spike after beating Wall Street's fiscal first quarter targets. At least 7 Wall Street analysts raised their price targets on HP stock after the company's first quarter report late Wednesday. Okay, this was last week. So Yahoo Finance reported this, and as you can see, if we look at the chart, that's where the earnings came out. Look at how the stock jumped up, on that announcement. Okay, that's great. And this is what most people trade. They'll see these earnings and they'll say, "Boy, I'm going to buy it." And usually, that's the time when you should be, moving your stop up to get out or exiting the trade altogether. Because if we use the simple technique which I revealed to you today, all you had to do was add the Bollinger Bands, and you see at the beginning of February we had 5 closes above. We had our short-term pivot high right here. You could have entered a full 3 weeks before that announcement came out, okay? And here are the different exit points. You would have exited actually on the day the earnings announcement came out. The stock gained 15% in just 2 weeks. Most people don't make 15%, on their gains of their stocks in a year. But this is how easy it is. Once again, I don't listen to news. I don't follow all these things that conventional traders do because it's been estimated that roughly 80% of all traders fail. And I think it's because we're following these conventional ways that have no levels of consistency. Sure, there are a couple of percentage points of people, traders, that are able to use them and make money, but the majority of us, myself included, aren't able to discern how these things, these conventional standards work. Be they volume, Fibonacci retracements, institutional, signs. It just doesn't make sense. There's no consistency because they're too discretionary. The only thing that's consistent is by following the price and being able to learn how to listen, okay? Now let's look at the E-mini S&P because I know a lot of you trade that on an intraday basis. Here's a 60-minute chart, an older chart of last year. As you can see, we are above the Bollinger Bands. We have our short-term top created there. So you would have entered at 21.12 and a quarter. That's your range extension, and at the 200% range extension, by the end of the next day, that's 33 points. That's over $1,600 per contract. And remember, we always say to protect yourself, at least take a little bit off the table here if you're not going to exit everything at 200%, because oftentimes the trend can change, as you just see right there. Okay, but it isn't uncanny the way it will go right up to those range extensions. Here's a 5-minute chart of the E-mini, okay? Obviously, we were above the Bollinger Bands, then we crossed below. So there was no setup here because we never broke out above, but we had 1, 2, 3, 4, 5 closes, and we still haven't created a short-term pivot low, but right here we created it, all right? So that's our entry point. We simply measure the range, and then we subtract it, and by the end of the day, we've got 61 points we could have taken advantage of. That's over $3,000 per contract on a 5-minute time frame. Now, just to show you that we're not cherry picking, here's what happened yesterday. Okay, this was the very last hour of the day because we've found that for intraday traders, a lot of the movement comes in the beginning of the market session at the end. That's where the volatility is. So a lot of our intraday traders like to use this during those time periods. Here's a 1-minute chart of the E-mini S&P. As you can see here in the far right-hand corner, this was coming into the 27th, which will be Monday. Okay. Now, obviously, we had a really nice run up here in the last hour of the day. How could we have taken advantage of that in hindsight? We add the Bollinger Bands. We have 1, 2, 3, 4, 5 closes, and here's our short-term pivot high. So you would have entered right above here at 23.60 1/4. You measure the range of where the move was, and you could have exited at 200 at 23.62 3/4 for 2.5 point gain. Or if you went for 300, you could have gotten out right at the high at 65.50 for a little over a 5-point gain. Okay, and once again, your stop would have been here at the median level, so you were roughly risking a couple of points to make 5. Now, this just happened yesterday, at the very end of the day. So just to show you how well this technique works. Now, we know we have some currency traders here. On the forex markets, nothing changes. It makes no difference because we've changed markets and time frames. Here's in the chart, a 4-hour chart, the Australian dollar. Obviously, we are above the highest Bollinger Band. At this point, we have 1, 2, 3, 4, 5 closes above. We have a nice pivot high here, but look what happened. We went and closed below. So all bets are off. We negate that setup, but now we have another 5 closes above. So this is our new setup. Here's our new short-term pivot high. You could have entered right here at 76.77, measure the range, and then exited for a quick 67 pips in a couple of days, or $670. If you want to go for the big moves, here's a daily chart on the Canadian dollar because the forex charts have these really, really strong trends at times. And I found that this technique works extremely well on forex trading. We are originally above the high Bollinger Band here, but we never have a pivot high that is broken out of. So there's no continuation to the upside. Once we start closing below, we negate the setup, and now we have 5 closes below, and we've created a short-term pivot low. So this is our setup to go short now. So instead of looking to go long, we've changed gears, and now we're switching to go short. That's what traders do. We just follow what the market does. We don't care what direction we're going in. We don't care what the economic news is. Whatever the market is telling us it wants to do, we just jump on board. It's like a train that's heading from point A to point B. All right? You're not going to stand in front of it. You're going to jump on board. So we're jumping on board here to go short. You would have entered at 39.05. You measure the range from top to bottom, and then you simply subtract it, 200 and 300. And from last February to May, well, that was 1,560 pips, roughly about $15,000 if you stayed in the entire time. And you see how the trend changed right after that. Okay, so let's recap before we go to question and answers. Let's talk about strategy 3A highlights. Remember, this is a continuation strategy. We're not trying to pick tops and bottoms. We're waiting for some type of indication that a small trend has begun. And then we're looking for specific structure so that we can jump on board once it continues in that direction, because most likely it's going to be a really strong trend in that direction. Now, we use a unique Bollinger Band setting. For those of you who missed it or came in late or didn't write it down, remember, the standard Bollinger Band setting is set to a deviation of +2 and -2. The median Bollinger Band, which is simply a 20-period moving average, stays the same at 20 period, okay? Simple moving average. But we're changing the upper and lower deviation. Instead of reading 2 and -2, we're changing it to a fraction, to +0.382 and -0.382. Okay, that will give us that really smooth type of Bollinger Band setting. Okay, this is designed to trade quick, powerful trends, but remember to protect yourself. Place that stop at the 50% level or anywhere you'd like to place your stop, if it makes you feel comfortable. Now, this can be applied to any market, any time frame, in any direction. You just saw me show you examples in stocks. I showed you examples in futures, in ETFs, in indices. I showed you example in the currency pair. So it doesn't matter. All right? But please, as with all of our numerous strategies and techniques we teach and trade at Specialist Trading, we always advise our students to paper trade first. I know your eyes are probably lighting up and you're looking for examples on current chart settings right now. But please, if you don't study this enough, inevitably you're going to lose money because you will implement it correctly. You won't be looking at you won't have the proper Bollinger Band setting. You'll be entering at the wrong place. You'll be exiting at the wrong place. And then you'll say, this stuff doesn't work. But it really does have a nice consistency to it. It's just that you're implementing it incorrectly. So study it, watch the video if you like, and practice it for a while. Our edge here is consistency. Once again, we're not promising the world. We're not promising that every trade is a winner. But that's okay. That's just the way life is. Nothing is a winner 100% in anything in life. It's all about managing your losses and being able to recoup them right away. And this is what we really feel strongly about, all of our techniques. In my 40 years of trading, I only use and teach the things that I've seen that have a high level of consistency. Okay? Now, before you ask me questions, I'd like to ask you a question, and ask yourself honestly, do you think this edge could have helped your trading this past year? I mean, we're already starting a couple of days into the third month of 2017. Most traders, when they start the beginning of the year, they make themselves all these promises and all these hopes and dreams and goals about where they want to be at such a place for the year. And I can honestly say that most of them never reach them. In fact, by halfway through the year, most traders know that they'll never reach those goals, okay? So ask yourself, how is your trading going so far this year? Is it anywhere near where you thought it was going to be coming into March, okay? Do you think this edge could have helped you, all right? It was totally free. There's nothing you had to purchase. What if I give you many more edges? What if I give you 3 more strategies that were just as consistent as this, but entirely different? Okay. Well, here's what we're going to offer all of the attendees today for the Traders Roundtable Conference. Here's our special attendee discount. This is a great discount. It's our Wisdom, Insights, Wisdom, and Trading Strategies from the Floor ebook. It's a great new package we have for all of our attendees today. And what is included in that are 3 brand new strategies. Okay, I gave you strategy 3A. In this ebook, we give you the complete rules to not only strategy 1, but strategy 2 and the benchmark strategy 3. Okay? In fact, let me show you some of the signals that were generated using some of these strategies. Here's a chart in HAL a few months ago now. Someone looking at this would say, well, Steve, the chat room I go to says that this is really in a downtrend. The institutions are selling this, and actually we broke a major support here, the Fibonacci or support and resistance. So this is a sell according to my synopsis here, okay? Well, in all actuality, strategy number, I believe it was strategy number 1, generated a buy signal. And as you can see here, look what happened right after that, okay? You'll get all the complete rules to this strategy in the ebook course. As well, it works to the downside. Someone looking at this would say, well, this is making a base. We've got a really nice support here. This is where all the institutions are buying. The volume is picked up, so I'm going to look to buy this. Well, strategy number 1 generated a sell signal, okay? And look what happened to the stock the very next day. Now, we also have the strategies that can work. These strategies work on any market, any time frame, but here's strategy number 3, which is a pullback strategy as well on a 10-minute chart of the E-mini. This was just this last week, or a couple of weeks ago. It looked as if the market was rolling over at the end of the day. Had you bought on a 10-minute time frame, look at the market the very next day. And you can still apply this to currency pairs. Here's the Australian dollar using the same strategy, strategy 3. And this is different from the 3A I just sent you because this is more of a pullback strategy. As you notice, we're not trying to purchase or sell on breakouts. We're purchasing and selling on a pullback. So because it's a pullback method, you're getting to sell or buy at higher or lower prices. So a sell was generated here using strategy 3A on the Australian dollar. And look what happened right after that. In this complete trading course, you're getting all the rules to strategy 1, strategy 2, and strategy number 3. All right, you already have strategy 3A, so you're basically going to get 4 strategies altogether, okay? I also talk about what happened during the crash. You'll get into a detailed, minute-by-minute explanation of how I traded through the crash and all the different things I had to go through during that week leading up to it and what happened afterwards, okay? I'm going to talk about the best ways to trade with the trend. I'm going to give you a lot more high-probability trading edges, Plus, I'm going to talk about the confirmation method, which is a great method for fine-tuning your entries. All of this, jam-packed, tons of information in our Insights, Wisdom, and Trading Strategies from the 4 course, okay? And the 3 trading strategies included. This is usually running for $99, this ebook. We're discounting it today for all the people in attendance down to $38, okay? But this is for a limited time only. Now, I can honestly say most of you, if you traded yesterday, probably spend more than $38 in commission costs alone trading. So this is jam-packed information. It's yours for life. It's yours to keep. And also, if you see at the very bottom bullet point there, I think one of the best things about this is that you have mentoring correspondence with me, someone who's been applying these techniques and strategies for the last 40 years. You can email me through email correspondence, and I'll answer any question you may have. So you're now a student of mine. So all of this usually runs, roughly $100. We're getting this for all of you just for $38. Once again, just for a limited time only. So here's how to take advantage of that. Pro Trader Strategies is my sister site. They manage and promote all of my courses and all of my different ebooks. You can email them at trading@protraderstrategies.com. You can also call them directly, 310-598-6677. And the link you see at the very bottom is the link that will take you directly to that $38 sign-up. But it's not a live link, so if you go, I believe Jeanette has posted it on the chat box. If you go to the chat box, there is a live link there for that special offer. So lots of great stuff. So please feel free to contact Pro Trader Strategies if you have any questions. And I'll take the last, I guess, 5 or 10 minutes for questions now. I want to thank you so much for holding off. Let me just open the question and answer box. Looks helpful. Yes, it does. Okay, sure. It is very helpful. Let me just scroll down here. Let's see. Chandra is saying, if this technique is applied to 2 different time frames, hourly and say 4-hourly day bar, and if the signals contradict each other, do you choose or do you close the trade? That's a good question. Here's what I have learned in 4 decades of trading. I know that that is a very common way to trade, by using and looking at 2 different time frames, either at the actual chart or looking at 2 different time frames of an indicator, okay? And making sure that they're in sync together, and that's how you determine whether you should take the trade. I believe that's what you're asking. It has been my personal experience in the 40 years I've been trading that there is absolutely no consistency in using this technique. Okay, I'm sorry, that's just my personal opinion. I don't use that. The only thing, I tried using that when I first started trading. I used all the conventional things the way most people do, but in using that, all I found was that it kept me out of a lot of good trades while I was waiting for the 2 time frames to match up. So here's what I suggest, and here's what I teach all of our students around the world. The basic format is only trade the chart that generated the signal. That's it. If you're looking at a 5-minute chart and a signal is generated on that, that's all you're interested in. That's all you care about. Do not concern yourself with a higher time frame. If you're trading an hourly chart, you have no reason to look at the daily chart, and vice versa. I mean, it just, once again, you're free to do that. We're not here to tell you how to trade, but if you're asking for my opinion, I have found no consistency in using this. All it does is keep me out of a lot of good trades. So our suggestion to all of our members is just keep it simple. Why overcomplicate your trading by looking at an entirely different time frame to make sure they come in line? Okay, I know it's conventional wisdom, but as I said at the beginning of this presentation, I struggled for my first 2 years of trading. I was doing all the conventional things you're supposed to, and nothing worked. So once my mentors taught me to let go of all this, that's when I started to become consistent. So it's up to you, but my suggestion is that it's not required at all. We don't teach or use that method in any of our trading at Specialist Trading, okay? Arnold asks, so what is the win-loss ratio of your strategy? Well, Arnold, first of all, you cannot put statistics or ratios to a strategy. You can do that with systems, and the reason is because a system is traded the same way each and every time, okay? A system basically has a set of rules, and even if the market's quiet, if the market's crazy, if the market's volatile, if it's going sideways, regardless if you're trading a 5-minute or an hourly chart or a monthly chart, you have to implement the rules the same way each and every time. We don't believe in that. Remember, we stated the reason why most traders fail is because you're relying on someone or something else to tell you how to trade. Now, that could be a system. What we want to do is teach strategies which are roughly 70% rule-based, but then give you 30% leeway or option for using your own insight. Remember I said some of our traders like to exit everything at the 200% level. Others like to exit at 300. Still someone will go for the largest gain at 400. Some traders like to move their stop up. Some like to leave it at the 50%, okay? There are 1,000,001 ways to trade it. We're not an optimization company. We don't sit and put statistics together for all the 1,000,001 ways one can trade. It would be silly. What we do is teach you all these things that have stood the test of time and then work with you so that you can apply it to your own needs so that you feel comfortable. That, in my opinion, is the only way one becomes consistent, not by listening to someone else, okay? So, as I stated in the beginning, we give you the information that has stood the test of time in 4 decades and then work with you so that you feel comfortable in picking away on how to use it. Therefore, there's absolutely no way we can have a win-loss ratio or statistics or a number such of that, okay? I hope that makes sense. Rebecca says, you explained it very well. I think I'll like this strategy. Yes, and remember, we're just trying to show you in good faith that we're an educational company. We're not some vendor. I just gave you a really good, strategy for free. I mean, you have all the complete rules right now. If you decide to become a member of our $38 course, or not, if that's too much for you, that's okay. We still left you with something that you can start using as early as Monday, okay? So this just shows you what we believe in. We're all about educating you. We would like to do that more because it makes no difference. It makes no difference if to us if you're winning or losing. Everyone, there's enough for everyone to go around in terms of the markets. Let's see here. Excellent. Thank you. You're very welcome. Do you have to use Fibonacci extensions for these strategies? Oh, that's a good question, Rebecca. A lot of people say that because they say, oh, okay, I see that 0.382 is a Fibonacci number. Now, when I was introduced to this strategy some 35 years ago, I asked my mentors the same thing. I said, why is it 382? That's Fibonacci. And they said, listen, it's just, you can experiment with anything you like. Some traders like to use 0.50. Some like to use 0.44. It's up to you. It's just that we have found that this setting works the best overall in all markets and time frames. So if you want to make it mysterious and say it's Fibonacci, that's fine. If you just want to say that's the best setting or change it to something, that's fine. Just experiment. Remember, this is what we're saying. We don't teach systems, meaning that, no, you can't change it. It has to stay there. Feel free to experiment. And in fact, we encourage this. We want you to find something that feels comfortable for you, okay? Can you use candlesticks in lieu of bars? Sure. If you notice, a lot of our examples were with candlesticks. The only difference is that people get confused because they look at the bodies as if that's the open and close, and as if that's where you place your entries. Remember, a top of a standard open, high, low, close bar is no different from the top of a wick. They're the same thing. So if you're looking to buy one tick above the high of the bar, that's the high of the wick. If you're looking to go short one tick below the low of the bar and you're using candlesticks, that's just the low of the wick. All right? There's absolutely no difference which type of bars you'd like to use, okay? Teresa asks, for swing trading, how many days on time frame are you looking at using a daily chart? It's really up to you. Basically, all you're looking for is basically, there's no way to statistically point out that you're going to be in this trade, 2 weeks, a month. Most of them I've seen offhand, when you're looking at daily bars, can last anywhere from 2 weeks to a couple of months, okay? It all has to do with getting that countdown and seeing how volatile the market are. So this is where paper trading comes into play. This is why we say paper trade, so you can get a better idea, okay? Let's see. Question, will 3A work with tick charts? Sure, works great with tick charts. I was trading it with tick charts last week, and it works fine. And it works, in my opinion. Remember, once again, we're just throwing this out there. We're not telling you what to do. But in my opinion, the most volatile times for the markets are the opening and the close. So you will see a lot of these setups at those specific times, especially if you're using tick charts, okay? JB says multiple time frames are excellent. That's great if it works for you. Once again, if you recall, I just said this is my suggestion. We will never tell anyone you cannot or can trade with this. I don't use news. I haven't looked at news in nearly 40 years. If we have a student that says, Steve, I'm sorry, I can't cut the umbilical cord, I have to look at news, I'm not going to tell him he can't do that. It's up to you. but you just have to be responsible for your results, okay? You may miss a lot of trades, and you're waiting for the time frames to line up, but that's okay. If that works for you, fine, okay? Is this Bollinger Band strategy based on momentum? Yes, it is, but we're basing it off of breakout. In other words, you see the momentum with the 5 closes above that high Bollinger Band. And as long as we stay above those Bollinger Bands, momentum is building up. Now, once we break out above that short-term pivot high, that's when the momentum is usually breaking out. Not guaranteed, but that's a good sign, and that's where we jump on board. Think of a train at the train station, okay? And it's just kind of sitting there. And all of a sudden, you see it starting to go, all right? It's building up momentum. Now it starts to speed up, and now you realize it's going in the direction you want to go. So you have to hurry up and jump on board before it takes off. That's what this strategy is. It's starting to build up, and then once it creates that pivot point, it's telling you that if we break out of that, we're going to leave. We're going to most likely take off. So that's where you want to jump on board. So this is really a really good momentum breakout type of strategy. Marie says, yes, I agree. Looking at multiple time frames will give you false signals to me. Yeah, you know, once again, if you love it, if you just swear by multiple time frames, that's fine. My own personal experience, I have found no consistency, absolutely none, in applying different time frames. Okay, sometimes it works, sometimes it doesn't. But most of the time, I'll have a good signal on a smaller time frame, and when I use that technique, I said, well, I can't take this until the higher time frame is in sync with the lower and vice versa. And then by that time, it's usually too late and I miss the trade altogether. So our method is only trade the chart you're looking at. Keep things as simple as possible. There's no reason to pile things onto your trading plan. It's been my experience that most traders think that the more complicated your strategy or method is, the more valid it will be and more successful. But my experience has been in 40 years that it's the opposite. The simpler, the least amount of rules, the least amount of things you give yourself to monitor and look at are actually giving you a higher probability for success. If you notice, this strategy only had 4 or 5 rules. That's it. Most traders, if they've been trading a relatively long time, that's 30, 40 years, have very simple trading plans. It's the traders who've been trading a relatively short time, 5, 10 years, who have all this convoluted logic and tons of rules and systematic nature. It's too complicated. The traders who have been trading that long, it's for a reason. It's because they keep things simple, okay? I think I'm just about out of time. I want to thank everyone for attending today. I hope you come on board. Contact Pro Trader Strategies. There's the link in the far right. If you have any questions or something, there's a mistake or something doesn't make sense, contact Pro Trader Strategies. Once you become a student of mine, you'll have my email address and you can contact me personally, okay? I want to thank Traders Roundtable for inviting me. Thanks to Jeanette, and thank you all. Stick around. More great speakers coming up, and thanks a lot. Have a great weekend, okay? Best of luck trading. Bye-bye.